Depreciation. Definition. Depreciation can be defined as the method of allocating the cost of physical asset over its useful life. In simple words, depreciation is the reduction in the value of an asset due to passage of time, normal wear and tear, and obsolescence. Depreciation is generally regarded as a non-cash expenditure and helps companies to reduce their taxable income. In the balance sheet, we need to show true and fair view of assets and liabilities as on a particular date. In this context, fixed assets include plant and machinery, equipment, and furniture which give long-term service to the organization. Therefore, by their usage, assets deplete in their value to the extent they are used and thereby reduce their lifespan accordingly. The reduction in the value of the asset due to usage, wear and tear, passage of time, or obsolescence is known as depreciation. For the purpose of reflecting the fixed assets in their true and fair values, the depreciation has to be worked out and accumulated through the life of the asset and reduced from its cost to bring the value to the true and fair state of affairs in the organization as on a particular date. Causes of depreciation. 1. Wear and tear due to usage or passage of time. Wear and tear is nothing but deterioration and the following decrease in the value of an asset, resulting from its use in business operations for earning revenue. 2. Expiration of legal rights. Some categories of assets lose their value after the agreement directing their use in business comes to an end after the expire of the predetermined period. 3. Obsolescence. Obsolescence is another factor driving to the depreciation of fixed assets. In common language, obsolescence means being out of date. Obsolescence refers to an actual asset being outdated on account of the availability of a better type of asset. 4. Abnormal factors. Drop in the use of the asset may be caused by abnormal factors, namely accidents due to earthquake, fire, floods, etc. Accidental loss is permanent but not continuing. The need of providing depreciation. The amount of accumulated as profit during the useful period of the asset can be used for the replacement after its expiration period. The capital amount should be secured without affecting the period of inflation in the economy, so it must be well planned. In a way, true profit obtained as a result of the asset is to be taken as the business expenditure. To ascertain that we can use depreciation. As depreciation is considered a statutory need, it must be calculated accordingly before the profits are shared in the dividends. Just like any other concept, depreciation methods also have got their benefits. As already said, depreciation is the expense of a business, so we can check it with calculated depreciation as they both are matching ones. After calculation of depreciation, we get the tax benefits and also the replacement cost too. Uses of depreciation method. Depreciation is important since an asset will definitely undergo wear and tear over a period of time. This leads to a reduction in working capacity and effectiveness of assets. Therefore, it should reflect the asset value which it is carried in the books of accounts. Each asset becomes obsolete over time when the new technology takes over. The asset value will decrease over time and it must be accounted for. Features of depreciation and the methods. Every asset has only a timely use, and with that the value has declined accordingly. So the measure of declination of asset value over the period is calculated with depreciation. The major features of depreciation are listed below. Depreciation is a decrease in the value of fixed assets. Depreciation involves loss of value of assets due to the passage of time and obsolescence. Depreciation is a continuous process until the useful life period of the asset, we must deduct the cost of expiration, that is depreciation, before calculating the taxable profit. It does not involve cash flow, hence it can be called a non-cash expense. Factors affecting amount of depreciation. Several factors affect depreciation. Following are the four main affecting factors while calculating depreciation expense. Asset cost. Estimated salvage value of the asset. Estimated useful life of an asset. Obsolescence. While determining the useful life of an asset, an equipment that can produce units for more than 10 years can become obsolete in 6 years. In this case, the useful life of an asset is 6 years. Methods of depreciation and how to calculate depreciation. In accounting, there are various methods for calculating depreciation. A company can adopt any of these methods of calculating depreciation depending on its needs. Some of the methods for calculating depreciation are 1. Straight line method, 2. Written down value method, 3. Double decline balance method, 4. Annuity method, 5. Sinking fund method, 6. Production unit method, 7. Sum of the years digits depreciation method. 1. Straight line method. The straight line method of depreciation is the most simple and easy to use depreciation method. It is the most commonly used method of depreciation. It is also called the original cost method, fixed installment method, or equal installment method. Under this method, the depreciation calculation is done by deducting the residual value from the cost of the asset, and then the amount is divided by the number of years the asset was used for or its useful life. The same amount of depreciation is charged every year on the original cost of the asset. The amount of depreciation is charged to the profit and loss account every year. For better understanding, we have given the straight line depreciation formula. Straight line depreciation formula is cost of asset minus residual value by useful life of an asset. Depreciation rate formula. Amount of depreciation as calculated above by original cost of the asset into 100. Consider a piece of equipment that costs $26,500. It has an estimated useful life of 8 years and the $2,500 salvage value. Depreciation expense per year will be as under. Years 1, 2, 3, 4, 5, 6, 7, 8. Straight line method. Opening book value is 26,500. It has a life of 8 years, and in the first year we have to work out the depreciation expense as under. 26,500 minus 2,500 by 8, that is 3,000 annually. It comes every year, 3,000 annually. And at the end of the 8th year, $2,500 salvage value is remaining. 2. Written down value method. The written down value method, also known as diminishing balance method or reducing balance method, is a method of calculating depreciation in which a fixed percent of depreciation is charged on the reducing value of the asset every year. While calculating depreciation in the diminishing balance method, the salvage value of the asset is not taken into consideration. The amount of depreciation decreases every year under this method. The diminishing depreciation method is calculated by the formula depreciation reducing balance method. Rate of depreciation into book value. Double declining balance method. Some companies or organizations also use the double declining balance method, which results in a large amount of depreciation expense. Double declining balance method is a type of diminishing balance method in which the depreciation factor is 2x than the straight line method. 4. Annuity method. The annuity method of depreciation calculates depreciation on the asset by calculating its rate of return. This method considers the asset as an investment. It takes into consideration the internal rate of returns on the cash outflow and inflows of the asset. Depreciation cost formula under the annuity method is depreciation is equal to cost of the asset minus residual value into annuity factor. 5. Sinking fund method. The sinking fund method of depreciation is a method of calculating depreciation where enough amount is accumulated at the end to replace the asset at the end of its useful life. Here, the amount of depreciation is charged to a sinking fund account, which is invested in various government bonds and securities. The interest earned from these securities is used to replace the asset at the end of its life. Production unit method. The production unit method takes into consideration the number of units that the machine has produced in a year. The depreciation cost depends on how much the machine or asset has been used over a year. The amount of depreciation formula under this method is depreciation is equal to estimated total cost minus residual value by estimated total output into actual output during the year. 7. Sum of the year's digits depreciation method. This is one of the acceleration depreciation methods. Higher expense are incurred in the early years and lower expense in later years of an asset's useful life. Divide the remaining life of an asset by the sum of years. You will multiply it by the depreciating base for determining the depreciation expense. Depreciation expense is equal to remaining life by sum of years digits into cost minus salvage value. The depreciation base remains constant throughout the year. Depreciation base is equal to cost minus salvage value. That is equal to, in our example, $26,500 minus $2,500, $24,000. Initially, the asset has 8 years as its remaining life. The following years, its remaining life is 7 years, and so on. So, RL by SYD is remaining of life divided by sum of years. Over here, the useful life of an asset is 8 years. The sum of years is 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 is equal to 36 years. The remaining life at the year beginning is 8 years. Therefore, RM by SYD is equal to 8 by 36 is equal to 0.222. You will multiply RL by SYD by the depreciating base for determining the expense of that year. This will be done for the following years. After the beginning of second year, RL by SYD is equal to 7 by 36, that is equal to 0.1944. Expense for second year is 0.1944 into 24,000, that is equal to 4,665.6. Conclusion. Finally, of all the methods of depreciation, only two methods, that is the straight line method and written down value method, are only popular and appropriate in use as per their nature of the method, which are as under: straight line method and written down value method. Basis of charging depreciation. Under straight line method, depreciation is calculated on the original cost of fixed assets. In the written down value method, depreciation is calculated on the book value of fixed assets. Amount of annual depreciation under straight line method is the combined cost of on account of depreciation and repairs is lower than the initial years and higher in the latter years. In written down value method, the amount of depreciation declines year after year. Recognition by income tax. Under straight line method, the straight line method is not recognized by the income tax department. The written down value method is recognized by the income tax department. Cost of depreciation and repairs. The amount of annual depreciation is fixed for all years of useful life. The combined cost on account of depreciation and repairs remains more or less equal throughout the life of the asset.